Hello everyone! Bigbear.ai Holdings is trading around 7.21 per share, marking a decline of just over 3% for the session. For casual investors glancing at the chart, it might look like just another ordinary down day in a volatile tech stock. But underneath that surface-level movement, something much more important is happening. Something that could define the company's next chapter far more than any one day's price action. Many retail traders are fixated on the artificial intelligence buzz. The idea that Bigbear.ai represents a pure-play opportunity in a world increasingly driven by AI and defense technology. They see it as a smaller, faster, and perhaps more innovative version of Palantir, a company with the potential to secure massive government contracts and ride the global AI wave to new heights. It's a clean, exciting story. Bigbear.ai builds sophisticated decision intelligence systems. Global tensions are rising. The U.S. government is pouring billions into defense innovation, and therefore this stock should soar. That's the story the internet loves. But the truth, as always, is much more complicated. The hidden reality behind the AI narrative. In recent months, Bigbear.ai has been engaging in a series of capital-raising moves, including multiple at-the-market offerings. These fundraising efforts have dramatically increased the company's outstanding share count. While this has brought in much-needed cash for operations, research, and potential acquisitions, it also carries a heavy cost, dilution. When a company issues new shares, every existing share becomes a smaller piece of the pie. This isn't just a minor accounting detail. It directly affects how easily a stock can appreciate. For Bigbear.ai's share price to double, its overall market capitalization now has to grow even faster because there are so many more shares in circulation. In other words, the more the company dilutes, the harder it becomes for shareholders to see meaningful upside. And this dilution isn't happening in a vacuum. The company is still not consistently profitable, meaning it must frequently turn to the capital markets to stay afloat. This creates a constant tug-of-war between the dream of big government contracts and the very real financial pressure of maintaining operations without reliable earnings. On today's chart, Bigbear.ai opened the session at $7.37, briefly touched $7.50, but eventually slipped to an intraday low near $7.16. That's more than a random dip. It represents the ongoing battle between believers in the AI story and skeptics scrutinizing the balance sheet. The volume isn't unusually high, but the pattern of trading tells the real story. The stock's inability to hold its morning highs shows a lack of conviction from buyers. Sellers are seizing on any sign of weakness to unload positions. Over the past several weeks, this back-and-forth behavior has created a choppy, unstable trading range. Whenever a competitor announces a big contract, or when broader market news like inflation data hits, Bigbear.ai tends to react dramatically, far more than large-cap peers. That's partly due to its smaller market cap and partly due to its popularity among retail traders who amplify volatility with emotion-driven trading. A large portion of the conversation surrounding Bigbear.ai takes place on social platforms like X, formerly Twitter, and Reddit, where bullish narratives often drown out sober analysis. Posts celebrate the company's technology, particularly its ProModel and Savant AI platforms, and make bold predictions about future government contracts. What's missing in most of those conversations, however, is an honest discussion of the company's financial statements. Government contracting is not a fast-moving business. Deals take months or even years to negotiate and approve. Even once a contract is won, the revenue recognition process is gradual. This means that investors expecting explosive short-term growth are often disappointed. The company's most recent earnings report illustrated this tension perfectly. Revenue grew modestly, but losses widened. Management's guidance projected optimism, but came with plenty of cautionary language about the timing and uncertainty of new awards. Investors wanted blockbuster numbers. Instead, they got a reminder of how slow and uneven this industry can be. Here's something most retail investors don't talk about. Bigbear.ai has a high short interest. That means a substantial portion of the market is actively betting the stock will decline. Short sellers borrow shares, sell them, and hope to buy them back cheaper later. When short interest as a percentage of the float is high, it indicates serious skepticism about a company's fundamentals. In Bigbear.ai's case, short traders are likely focusing on three main risks. Valuation concerns. The company's market cap may not be justified by its current revenues or profitability. Ongoing dilution. Every new share issued makes each existing one worth a bit less. Competition. Rivals like Palantir, Leidos, and Booz Allen Hamilton have deep relationships with the U.S. government and vast resources, making it hard for a smaller player to gain a foothold. If you track the borrow fee rates for Bigbear.ai shares, you'll see they often spike around earnings announcements or major news events. A rising borrow rate can sometimes lead to a short squeeze, where bearish traders rush to cover positions, causing a sharp rally. But most of the time, it simply reflects bearish conviction, a belief that the company's risks outweigh its upside potential. How to interpret these signals as an investor? If you're following Bigbear.ai, it's essential to go beyond social media hype. Look at official short interest reports, which are published on the FINRA website, albeit with some delay. For more real-time insights, services like Ortex, Fintel, or MarketBeat provide daily updates on short volume and borrow costs. A particularly important metric is days to cover, which measures how many days of normal trading it would take for all short positions to be closed out. A high number means that if a positive catalyst hits, like a big government contract, shorts could get squeezed badly. But it also implies that a lot of traders are deeply entrenched in their bearish positions and may see something in the fundamentals that others are ignoring. So the real question becomes, are these short sellers smart money, correctly identifying weaknesses, or are they overestimating the risks in a company that could be a future leader in decision intelligence? At its heart, Bigbear.ai operates in the decision intelligence sector, a branch of AI focused on turning massive, messy datasets into actionable insights. Its software is designed to help clients, especially within the U.S. government and defense community, make faster, better data-driven decisions. For example, Bigbear.ai's technology can predict the next move of an adversary, simulate battlefield logistics, or optimize the maintenance schedule of complex assets like aircraft fleets. These capabilities have obvious strategic value in national defense. While the company has begun exploring commercial markets, helping corporate clients optimize supply chains or manage logistics, its core revenue still comes from federal contracts. That focus on government work provides potential stability, but also exposes the company to long approval cycles, strict compliance standards, and budgetary unpredictability. It's also worth remembering that Bigbear.ai came to the public market through a SPAC merger. That history carries baggage, inflated initial valuations, non-traditional capital structures, and lingering skepticism among institutional investors. Many SPAC origin companies have struggled to establish consistent profitability, and Bigbear.ai is no exception so far. From a bullish perspective, the catalyst everyone is waiting for is clear: a major multi-year government contract. If Bigbear.ai wins a contract tied to a program like the Air Force's Advanced Battle Management System, ABMS, or a similar intelligence initiative, it would validate its technology and provide a long-term, recurring revenue stream. Another possible growth driver is the expansion into the commercial sector. If the company can prove that its AI models can optimize operations for large corporations as effectively as they do for military applications, its total addressable market could multiply dramatically. Success in that area would also diversify its income sources and reduce reliance on unpredictable government budgets. However, the bearish case is equally strong. Competition in defense AI is fierce. Established players like Palantir have entrenched government relationships, while agile startups constantly emerge with cutting-edge tech. Bigbear.ai risks getting caught in the middle, not big enough to dominate, not small enough to pivot quickly. Then there's the ever-present issue of cash burn and dilution. If the company keeps raising capital by issuing new shares, it may keep operations running, but at the expense of long-term shareholder value. Each new fundraising round makes it harder for the stock price to break out sustainably. The big question for investors. So where does that leave investors today? Bigbear.ai sits at the crossroads of massive opportunity and equally massive risk. Its AI technology clearly has potential, especially as data-driven defense systems become a priority for governments worldwide. But the financial structure, recurring dilution, inconsistent profitability, and dependence on speculative contract wins makes it a volatile bet. Comment below and share your thoughts. What do you think will define Bigbear.ai's success over the next 2 years? Will it be that long-awaited breakthrough contract that sends the stock soaring? Or will true success come only when the company demonstrates operational profitability and a stable financial foundation? The saga of Bigbear.ai is a perfect example of how exciting narratives can collide with harsh financial realities. The bullish vision paints a future where the company becomes a cornerstone of U.S. national security, providing indispensable AI tools to defense and intelligence agencies. The bearish reality reminds us that the road to that vision is paved with mounting expenses, fierce competition, and heavy reliance on investor capital. The elevated short interest shows just how divided the market is. Bulls see potential for explosive upside. Bears see a company burning cash and diluting shareholders. Both sides may be right in different timeframes. The question is, which one gets proven right first? If Bigbear.Ai secures a landmark deal or demonstrates clear profitability, shorts could be forced to cover, and the stock could surge dramatically. But without tangible progress, ongoing dilution and financial pressure may continue to cap the upside. As always, the key for investors is balance, separating hype from reality and storytelling from numbers. Bigbear.Ai's journey isn't over, but it's one that will test the patience and conviction of everyone watching. This video is created solely for educational and informational purposes. The content presented does not constitute financial advice, investment recommendations, or stock trading guidance. Viewers are encouraged to perform their own research and consult with a qualified financial advisor before making any investment decisions. The opinions expressed in this video are based on publicly available information and personal interpretation, which may not always be accurate or up to date. The creator of this content assumes no liability for any financial losses or decisions made based on this material. All investments carry risk, including the potential loss of principal. The stock market is volatile, and past performance does not guarantee future results.